Hi friends, so we are now starting with the next chapter in our theory discussion, which is on an area called as mutual funds, relatively a smaller area and one which should get over quickly. Let's first understand what is a mutual fund. That's the first question we are going to understand. So what does a mutual fund exactly do is, it is in the job of collecting money or pooling money from a lot of like-minded investors. Who is a like-minded investor? A person who has a common financial goal. So what mutual fund is technically going to do is, let's write the steps which a mutual fund basically does. It is going to collect money from multiple people. So pooling of money from like-minded investors. That is, people having a common financial goal. You collect money from them, invest this money in equity, debt, money market instrument, real estate, whatever is the objective, commodities, gold, precious metal. Invest this money in multiple places as per your scheme objective, earn return and distribute this return, after meeting its expenses. Mutual fund will have its own expenses. So after meeting the expenses, I am going to distribute this money back to the investors who have contributed money to the mutual fund. This distribution basically happens by increase in NAV. Whenever an MF investor wants to move out, he can move out as per his requirement. So a mutual fund is a trust that pools together the resources of investors to make a foray into investments. It can be invested in debt, equity, money market instrument, real estate, gold. You become a part owner of the assets of the mutual fund. The fund is being managed by a professional money manager, or technically called as a fund manager, who is going to invest in various assets like stock, bonds, other security according to the investment objective. As I explained in the regular class, mutual fund is an extremely important instrument for long-term wealth creation. Anybody who wants to create a long-term wealth, you can start even with a very small amount. You can start with 500 or 1000. Anybody with investable surplus can invest in the fund. So if you have some surplus available, you can go ahead and invest in a mutual fund. Now there are multiple classification of mutual fund based on functional, based on portfolio, based on ownership. Let's first discuss on functional classification, where I see questions on MCQ getting tested a lot. You have three types of scheme: open-ended scheme, close-ended scheme, and interval scheme. Open-ended scheme is one where you can make an entry and exit at any point of time. Entry and exit is allowed at any point of time. You want to buy a mutual fund today, you can buy an open-ended mutual fund. You want to sell this after 4 days, you can sell it. After 10 days, you can sell it. So open-ended is one where you can make an entry and exit. Entry or exit, both entry as well as exit, can happen at any time. In an open-ended scheme, the investor can make an entry and exit at any time. So there is no specific time period here. There's nothing like a specific time period. The redemption can happen anytime. You can redeem it today, you can redeem it after 10 years, 15 years, 20 years. It is like an irredeemable instrument, but whenever you want, you can redeem it. So that is why they say redemption period is indefinite. Indefinite means it can happen at any point of time. There's no specific time period I can give. And the amount of money which can be raised in this is unlimited, because people can keep bringing in. Close-ended is exactly opposite. Where you normally enter during the initial public offering. And exit will happen once the maturity happens. In a close-ended scheme, the investor can buy into the scheme during the initial public offering. The scheme has a limited life. At the end of the life, corpus is liquidated. Because close-ended does not allow me to exit at any point of time, it is mandatory that a close-ended fund is listed. It has to be listed in the stock exchange. So when it's listed in the stock exchange, you can buy this in the stock exchange and sell it in the stock exchange. Like in an equity share, what happens is, moment shares are issued, it is listed in the market. So I can buy the shares from someone else. Somebody wants to sell, he can sell it. Company never comes into picture. But in case of a mutual fund open-ended, company will do the buying from you and selling it to you. Whereas in a close-ended fund, because there is a specific entry point and a specific exit point, if you want an entry or exit in between, then it has to happen only through the stock markets. Interval fund is a combination which is open, and that is open for entry and allows exit at specific pre-specified intervals. So interval schemes are a combination of open-ended and a close-ended structure, allows for purchase and redemption during pre-specified interval, monthly, quarterly, annual. So there are certain specified intervals. At those intervals, you can make an entry and exit monthly, quarterly, annually at the prevailing NAV prices, whatever is the NAV prices. So open-ended, anytime entry, anytime exit. Close-ended, one-time entry during IPO, one-time exit during maturity. Interval, entry and exit at pre-specified interval, which could be a monthly, quarterly or annually. This is on functional classification. Then on portfolio level classification, we have equity funds, we have debt funds, and we have special funds. Equity funds are classified as growth, aggressive, income funds. Your debt fund classification is bond and gilt funds. And special, there are multiple categories, like you have an offshore fund, you have an index fund. Let's look at growth fund. Growth fund is basically looking for long-term capital appreciation. The objective is you invest in this fund at least for a period of 5 years. This is not to be confused with growth plan of an mutual fund. Growth funds are basically, the objective is to provide long-term capital appreciation. Aggressive funds, the name itself explains you, they are extremely risky kind of mutual fund. They are extremely risky kind of mutual fund. They are looking to give super normal returns. Super normal return is very high returns. They will give very high return. Obviously, they will also carry very high risk because they want to make investment in startup, IPO, speculative share. They are willing to take a lot of risk. Aggressive funds are those which are willing to take a lot of risk. Because we are taking a lot of risks, the returns can be on the higher side. So aggressive funds are basically one which are looking for super normal return. Now, whatever I'm explaining, growth, aggressive, income can get tested in an MCQ. What is income fund is, they are trying to maximize the present income of the investor. Present income is whatever the regular income they are going to get by investing in safe stock. Safe stock which has very high cash dividend, or you invest in money market instrument which has a high yield. Combination. Income funds can invest in safe stock having high dividends and also in high yield money market instrument. Objective is to give steady income. So the mutual fund will be getting steady dividend income that would get passed on to these guys. Debt fund, two categories are there, bond funds and gilt fund. Bond funds are going to invest in variety of debt instrument, which can be government bonds, corporate debentures, convertible debentures, money market instruments. So there are multiple categories which are there. Whenever you invest in a debt instrument, in your bond valuation, you have learned that there are multiple risks which are there in a debt instrument, which are interest rate risk, variation in cash flow due to changes in interest rate, credit risk is default risk, prepayment risk, if there is any prepayment done by the customer, what will happen, reinvestment risk. So basic category is bond funds are going to invest in multiple category of bonds, which can be government bond, corporate debentures, convertible debentures, and they carry a lot of risks which are there in case of bond valuation. Despite carrying all these risks, bond funds are considered to be less riskier than equity funds. Bond funds are considered to be less riskier because bond funds do not have major variation. There will not be any major variation in the performance. If you calculate standard deviation of a bond fund, you will not see major standard deviation being there. Equity fund carries high risk, high return. Bond funds carry low risk, low return. Another category is gilt fund. Gilt means they are going to invest in government security, only government security. Mainly invested in government security. So gilt funds are mainly invested in government security. Special funds, there are a lot of lists which are there. I can keep adding more lists also. Index fund is basically which is going to invest in an index. What is an index? India has an index called Nifty, mid cap index, small cap index, large cap index, or you can have an index called a Sensex. So here you are investing the money in stock index. Every stock market has a stock index which measures the upward and downward sentiment. Index funds are low cost funds and influence the stock market. Index funds are also called as passive funds. There is something called as active funds and passive funds. What is active funds is The fund manager will be doing a lot of buying and selling. He will have to do the job of selection of security. Active funds need a strong research team. Normally, most of the funds are active funds, but index is a passive fund. Passive fund because in the case of index, the fund manager is not going to do anything. He knows what are the stocks to be invested. He will just decide the index and keep putting money in that index. If there is any changes happening in index, in India, Nifty index can undergo a change. The government or the SEBI may say that we are removing this company from Nifty index and adding some other company. So there can be changes which happen in index. That time the index funds has to make a correction. Otherwise, index funds will continue to invest in all those companies. So Nifty has 50 companies means you'll invest in all the 50 companies in the proportion. What proportion? Whatever proportion they constitute in Nifty. So whatever proportion they are in the Nifty, in the same proportion you will make the investment. International funds is you are located in India. You are located in India, raise money in India, but invest abroad. Located in India, raise money in India, but invest in Singapore market or USA market. Offshore funds, I think there's an error there. Located outside India. This is located outside India, raises money outside India, and it will invest in India. This offshore funds sometimes are also called as tax haven funds. That is, you will try to make the investment from place where India has this DTAA agreement, because of which taxation impact may not be there. Double taxation avoidance agreement. If there are certain places where taxation benefits are there, you may list it there, raise money there, and invest in India. Sector funds, the name itself explains. Sector funds are going to basically invest the money in a particular sector. There's a real estate sector fund, there is an infrastructure sector fund, there's a banking sector fund. So you are going to invest this in a specific sector. Now, sector funds are extremely risky because diversification does not happen there. In a sector fund, you cannot have any kind of diversification happening. Why can't diversification happen? Because for diversification, I should invest in multiple businesses. In a sector fund, you're going to invest all your money in a single business. So, sector fund is technically like an undiversified fund. It is like an undiversified fund. Money market funds, the name itself explains. Money market funds is going to invest their money in money market instruments which have less than 1 year life. Examples we saw in the earlier chapter: CP, certificate of deposits, treasury bills, government security. Normally they are highly liquid and considered to be safe also. Fund of funds is going to basically invest in other mutual funds. So practically we have thousands of mutual funds which are there. So fund of fund is going to invest in other mutual fund schemes. Capital protection oriented fund. There is this type of a category called as where the focus is to ensure that there is no fall in the amount invested. Basically, I want to protect the principal. Capital protection oriented fund works towards protecting the principal given to a mutual fund. That is, I invested 1 lakh in a mutual fund. On 1 lakh return has to be earned, but I want this 1 lakh to be protected. So what capital protection fund does is, major portion of its asset will be for capital safety. What is capital safety? Invest in safe instruments like maybe some government security or certain bonds, and they are going to be invested in highly rated debt instrument. Balance some portion you may want to take risk. 80-90% no risk. 80-90% I don't want to take any risk. Balance 10-15% I may want to take risk for the purpose of capital appreciation, because I want some capital appreciation. This practical one, another thing called as capital guaranteed scheme. An example of a capital guaranteed scheme is a fixed deposit. In a FD, your capital is guaranteed. You will get back the capital. Capital protection oriented fund is not like a fixed deposit. It is not going to guarantee your capital because it also takes small amount of risk. 10% of its portfolio or a 20% of its portfolio, it will take risk in order to get a slightly higher return. Somebody says, no, I want full guarantee of my capital. Put money in fixed deposit. In a fixed deposit, your capital is almost guaranteed. Gold funds, the name explains, the gold funds is going to invest in gold. It is going to invest in the value of the gold or gold related instruments. Quant funds, this is something which is rapidly growing in the practical world. What is quant funds is, many a times whenever you are doing a purchase or a sale of a share or a purchase or a sale of a mutual fund, lot of times emotions play a part. I tell somebody that please buy a share. He did not buy the share. 2 days later, the price has gone up. Still, it is undervalued. The 2 days later, the price has gone up. Still, the share is undervalued. But your emotions are not allowing you to buy it, because you are saying, I could have bought it at a lower price. I missed it. Why should I buy it at a higher price? Emotions sometimes affect our decision making, rational decision making. I tell somebody to sell it at 1,000, price has fallen to 985. You are not ready to sell at 985 because I'm saying at 985 also it's overvalued. Please sell it. So that is where something came called as data driven approach. What is data driven approaches? There is going to be some algorithm. The algorithm will say buy the share and sell these shares. So based on the algorithm, based on predetermined rules or parameters using statistics or mathematics based models, you will use certain algorithms, automated programs, and then it will tell please do it. Human intervention is very minimal. Human intervention is very minimal as fund managers focus on robust models and continuously monitor performance. It eliminates the human biasness and subjectivity. Many times these emotions play a bigger role in final decision making. So I don't want the emotions to impact. That is only possible if you go through quant funds. Quant funds try to eliminate, and historically I've been seeing the performance of quant funds. They have been better than the normal set of funds because emotions play a big part in your normal funds. Funds can also be classified based on ownership. These are self-explanatory. Public sector mutual fund, private sector mutual fund, and foreign mutual fund. Public sector mutual fund is sponsored by a company of the public sector. Private is by the private sector, and foreign is by someone outside India. Are sponsored by companies for raising funds in India, operate from India, and invest in India. But these are sponsored by the companies outside India, foreign mutual funds. Explain about direct plan in a mutual fund. Now, mutual fund basically have two types of plan. One is called a regular plan and second is called a direct plan. For example, if I just check mutual fund NAV, mutual fund NAV, let's look at this. You see in the top, there is a direct plan and there is a regular plan. So this is NAV of direct plan 161.33. The NAV of regular plan is also there 154.429. ICICI Prudential Thematic Advantage Fund, direct plan 161.33, regular plan 154.429. Both the plans there is a NAV which is available. What is direct plan is whenever you invest in a mutual fund, lot of times you are going to use an intermediary. You are going to use an intermediary for the purpose of investing in a mutual fund. This intermediary will be paid a commission, by the mutual fund AMC. The mutual fund AMC is going to pay some commission to this mutual fund distributor. So you want to invest in mutual fund, you will say that I want to invest it through my bank. So bank is the intermediary. You want to use some portal, that portal becomes an intermediary. If you are directly investing through the AMC website or directly investing in certain tools given by the AMC, there are practical certain tools available. If you invest it directly, that is called direct plan without any intermediary. Mutual fund direct plans are those plans where asset management company or mutual fund houses do not charge distributor expenses, trail fees and transaction charges. These charges are not there in a direct plan because you do not go through a distributor. When you do not go through a distributor, your returns will obviously be on the higher side, slightly higher. But the only challenge is if you want to do it in direct plan, you need to have good understanding, because without having understanding of mutual funds, you will not be in a position to do direct plan. So if you see here, the NAV of direct plan is obviously going to be more than the NAV of the regular plan. 161 vis-a-vis 154 or 120 vis-a-vis 115. So studies have shown that direct plans have performed better than regular plans for almost all the mutual fund scheme. The only challenge is direct plan you can do only if you are aware of what funds to invest in. Else you take the help of a mutual fund distributor and they will help you in doing the investment. They will not be charging you anything, but they will be getting some commission from the asset management company. What are the various types of scheme in a mutual fund? Now, as you read it, you will find you can call it the schemes in mutual fund. Some of them are category of mutual fund itself. As I said, balanced fund. What is balanced fund? Is combination of debt and equity. It is a combination of debt and equity. What it does is it invests in debt as well as in equity. Debt is for protection, equity is for return. So debt provides stability, equity provides growth. So it tries to balance the risk. It tries to balance the risk or moderate risk, moderate return. Diversified funds. Diversified funds are those which have the benefit of diversification. Practically most of the funds will be diversified. Example, flexi cap, contra fund, index fund, dividend yield fund. Multiple categories of funds are there. So all these categories are called as equity diversified funds. Undiversified, I gave you an example, sector funds. Sector fund is undiversified. ELSS scheme. ELSS is basically investments done under section 80C. Investments done under section 80C. Sector funds is they are focusing only on a particular industry. They are focusing only on a particular industry. They are much riskier than the equity diversified funds. They are much riskier than the equity diversified funds. Thematic funds. Practically, this is a confusion which will be there. What is a sector fund and what is a thematic fund? Thematic fund focuses on certain themes. For example, Make in India is a theme. Make in India is a theme. So Make in India, because of Make in India, some company in manufacturing sector will do really well. Some company in construction can do well. Some company in maybe automobile sector can do well. So it can be from multi-sector, international exposure, but they are focusing on specific themes. Whatever theme you find, if you find Make in India as a theme, based on that, which companies are likely to do better. Arbitrage fund. The term arbitrage is basically trying to make profits without taking risk. So many a times you will do a valuation of a bond or a debenture and say it is undervalued or overvalued. When such opportunities come in the market, when such undervalued or overvalued opportunities come in the market, it can be exploited by arbitrage funds. It focuses to capitalize on the price differential. Price differentials. Wherever arbitrage opportunities are there, you are trying to capitalize on that. It can capitalize only in case there are certain price differential, which could be between spot and futures market, which could be between fair value as well as the current value. Hedge fund. I think among all the funds which I have discussed, hedge funds are considered to be extreme risky fund. They are considered to be extremely risky fund because there is no regulation. There is no regulation. They do not disclose most of the information. They are aggressively managed. They are aggressively managed. They are going to invest money in a lot of risky securities. Objective obviously is to generate very high return. The objective is to generate very high return, but you are going to take a lot of risks. Cash fund. Cash fund can be called as like a money market fund. Cash fund is like a money market fund. Open-ended liquid scheme. Open-ended liquid scheme. Low risk, low returns. Low risk and low return. Mostly because it is for a shorter period, it will not have any entry or exit load. Entry is the front end load. Exit is the back end load. Exchange traded fund. ETF is basically these which are listed on the stock exchange. One, all close-ended schemes have to be listed. That is mandatory. So whatever funds are listed on the stock exchange, they are called as ETF, exchange traded fund. You can buy this ETF at any point of time. Normally mutual fund, you place an order morning, you will get it only placed by the end of the day. The placement will happen only by the end of the day at the closing NAV. An ETF can be bought by placing an order and traded during the market hours. During the market hours. There are multiple ETFs there. Index ETF is there, commodities there, bond is there, currency is there. Fixed maturity plan. The term itself explains you. Fixed maturity means there is a specific maturity which is there. So obviously they are close-ended mutual fund because there is a specific maturity. Fixed maturity also focuses on giving you a fixed amount or a specified amount. Objective is to have stability. Because of this, they'll invest mostly in your money market instrument, certificate of deposits, commercial paper, money market instrument, non-convertible debentures. These are the places where you will try to invest and get something called as fixed income. Objective is to get fixed income, and they are for a specific time period. Because they are for a specific time period, it is also known as basically a close-ended mutual fund. Okay, next is what are the advantages and limitations of mutual funds? Mutual fund obviously carry a lot of advantages. To me, the most important advantage is getting the help of a professional management for long-term wealth creation. I can create wealth for a longer period of time. So professional management, diversification. If I tell you that you have to invest 5,000, you cannot invest in 10 shares, but with 5,000 you can invest in mutual fund, which will help you in this mutual fund would have diversified its investments across multiple places. Convenient administration, you need not keep monitoring this at multiple times. Higher returns over the longer run, we have seen mutual funds generating more returns. Low cost of management. What is low cost of management? The expense ratio has a cap. There is a lot of caps which is there. No mutual fund increase the cost beyond prescribed limit of 2.5% maximum. Liquidity is because it's open ended, you can do, and in case of close ended, you can do, you sell it through the units through stock exchange. Transparency is there, and there are certain benefits called a systematic investment plan, where you can do regular investment without timing the mutual fund, and also do systematic withdrawal, where you can regularly withdraw. And regulated, when it is regulated by SEBI or AMFI, Association of Mutual Funds of India, I can be rest assured that nothing will go wrong in a mutual fund. There are certain disadvantages of a mutual fund also. One is it can never give you any guarantee of return. If at all you have, maybe you could have seen this in an advertisement, and they'll talk about mutual fund, and finally they say mutual fund investments are subject to market risk. Mutual fund investments are subject to market risk because there are risks which are there in a mutual fund. Diversification is good, but diversification can help you in reducing risk, but it cannot give you maximum return. So maximum returns can't happen. Selection of proper funds, sometimes you'll find it very difficult to select the right fund because so many funds are there in the market. When I have to select a share, at least I can do EIC analysis, fundamental and technical analysis of one company. Mutual fund has made investments in 25-30 companies. So it is difficult for me to select a right mutual fund. Cost factor. What is cost factor? Is that expense ratio which is there. The expense ratio part which is there. What is the trail commission in relation to a mutual fund? Trail commission is basically amount which a mutual fund investor, the MF investor, pays to his advisor. Advisor is an intermediary who is going to be there. This advisor will be getting a fees from you. This advisor will be getting a fees from you. If you do a direct investment, then this fees is not there. You do a direct investment, this fees is not going to be there. You need to pay this to the advisor because advisor is going to do take care of your mutual fund investments. He will say that this is the fund we will buy, this is the fund we will sell. He will make advice, he will give you the right advice on what needs to be done. Is to provide incentive to the advisor to review the customer's holdings and give advice from time to time. On what is this commission charge? The commission is charged on the asset under management or your portfolio. Whatever is your portfolio, how do you calculate portfolio? Daily average. You end up taking daily average. Normally, this percentage could be 0.75%, 0.5%, 1%, whatever you want to, whatever the decision is. But this is the commission which would be paid. Expense ratio. This is very critical. Expense ratio is basically an expense ratio is basically the expenditure which a mutual fund incurs for its operations. What are the mutual fund operations there? Research needs to be done. You will have to account for purchase and sale. You will have to maintain records. There is an office which is needed. Some consultancy requirement can be there. Custodian is there. Audit is there. So for all of this, you will have to incur certain expenses. Who is going to bear the expenses? The mutual fund investor. The MF investor is going to bear all these expenses. These expenses will have to be borne by the mutual fund investor. Ultimately, he has to pay for all of this. Concept of side pocketing in mutual fund. This is a very good concept. This is applicable only in case of debt mutual fund. Applicable mostly in case of debt mutual fund. Now let's understand what is side pocketing. Let's understand this with a simple example. A mutual fund has invested in a debt mutual fund. 4 companies. It has invested in company 1, company 2, company 3, company 4. Now suddenly one of the companies facing a lot of challenges. It is a debt mutual fund which invested in the debt. Debt is basically it lent money. Company 1 is having a lot of trouble. So there is a possibility that company 1 may not return the money to us. The mutual fund may not get back the money from company 1 because it is facing a lot of trouble. If this money does not come, then the mutual fund is going to have a loss which will be paid by the MF investor. Ultimately, the loss will be borne by the MF investor. So company 1 now will become illiquid. What is illiquid is there is no money coming in. Company 2, company 3, company 4, I'm getting regular interest income, some repayments are coming, everything is coming. Company 1 has become illiquid. So I wanted to invest in this mutual fund, but I'm not liking this company 1. I wanted to invest in this mutual fund. I'm not liking this company 1 because it's an illiquid instrument, doesn't serve any purpose. Also, an existing investor sees this company 1, gets little irritated, saying that there is illiquid fund which is there, illiquid company which is there. Let me move out of this mutual fund. So a lot of people will try to exit out of the mutual fund moment they see this illiquid issue. Moment they see this illiquid issue, they are thinking, what is the point of containing in the mutual fund? So what the side pocketing is, you will remove this and shift it to another fund. Within the fund, you will shift this to another fund. And here, whenever, whatever day the side pocketing happens, that day, whoever were the investor will become part investor in this fund. Part investor. Whatever money is stuck here, you will try to take some legal action. You will try to recover the money. If the money is recovered, these investors will get the money. If this money is not recovered, these investors will not get the money. So you may be an investor in this illiquid fund. You will continue to be an investor in the illiquid fund. You can sell the liquid fund. That is, there is main fund which you want, you can sell it. This fund, you will not be in a position to sell it because people will not be ready to buy because it is a kind of an illiquid fund. So side pocketing leads to separation of risky asset from the other investments and cash holding. Risky asset, I am separating this. Purpose is to make sure that money invested in a mutual fund which is linked to stressed asset, gets locked until the fund recovers the money from the company or could avoid distress selling of illiquid security. So if I collect the money, I'll pass it on. Not able to collect the money, gone. A debt mutual fund invests in securities which normally enjoy high credit rating. Whenever the rating of a mutual fund decreases, what is rating decreases? Some company is facing trouble. The fund shifts the illiquid asset into a side pocket so that current unit holders can get benefited from liquid assets. So whatever NAV we are calculating, it will only be the value of liquid. Basically, it will be the value of C2, C3 and C4. C1 value is eliminated. C1 value is eliminated because it almost has zero value. Side pocketing is beneficial for those investors who wish to hold on to the units of the main fund for long term. Process of side pocketing ensures that liquidity is not the problem, even in case of some redemption. This side pocketing has been very prevalent internationally. In India's context, it has not been that prevalent, but the objective is very simple. Objective is to protect the liquid assets and remove the illiquid assets into a side pocket or into another fund where the existing investors will continue to be the investors. If money is recovered, it will be paid. Not recovered, they will have a loss. How to measure divergence or deviation of a return of a MF scheme that replicates any benchmark index? What is replication of a benchmark index? Is index fund. Index fund, there are a lot of index fund in the practical world. For example, you see here, you will find many index funds are there. Aditya Birla Sun Life Multi Index, HDFC Developed World Index. Apart from this, there should be some other funds also. Just give me a minute. Okay, I'm finding a list of only 5 funds here, but normally there are multiple funds which are there. So you have so many index funds which are there. What an index fund is going to do is the index fund is going to invest money in a specific index. So logically, if you are Nifty index fund, your return should be equal to Nifty's return. If you are a Sensex index fund, your return should be equal to Sensex. If you are a mid cap index, your return should be equal to mid cap. Small cap, your return should be equal to small cap. Track, sometimes this will not be equal. Nifty has given 10%. You have got 10.5, bad. You have got 9.5, that is also bad. Objective is to get a number close to 10%. Objective, more or less is problem. That more or less is called tracking error. Tracking error can be used to measure the divergence or deviation of the fund's return from the benchmark return it is following. From the benchmark, how much deviation it is happening. Index fund is basically for a passive fund manager. Passive fund manager closely follows or track the benchmark index. The objective, if you are a passive fund manager, objective is to have low tracking error. If you are an active fund manager, objective is to generate alpha. Alpha means outperformance. So although they're designed on the same index, sometimes you will not be able to replicate. Then there is a deviation which is happening. This deviation is called tracking error. The tracking error can also be because of these things: transaction cost, fees charged, expenses, fund expenses, cash holding, sampling bias. So there can be multiple other reasons also. In our problems, there is a problem on tracking error. The only thing that I want to talk about when you calculate tracking error is there is x, and then there is something called as x minus x bar, which is technically called as deviation, and then we do deviation square. X minus x bar, deviation square. You put a total of deviation square, and when you do standard deviation in portfolio chapter, you would be learning that whenever you do standard deviation, we normally used to take equal probability. Here, the concept of equal probability will not work. What you need to do is whatever data points they have given, write those data points, take a deviation, put a deviation square, and divide the deviation square by n minus 1. Divide the deviation square by n minus 1. We normally divide by n. N is used. This is a concept of standard deviation. You will divide by n when you have the entire data of a population. What is entire data of a population is, if you have returns for the last 100 months, you will have to take all the 100 months data. If you take the entire data, then when you calculate tracking error, denominator is n, d square by n. But if you have data only for 5 periods or 4 periods, denominator is n minus 1. So you will have to do this when you calculate tracking error. That is, take the differential return, then find out the x minus x bar, then do d square, but divide by n minus 1. How can you evaluate the performance of a mutual fund? Very, very critical. Because one, I wanted to know when do I enter into a mutual fund. That is critical. But I also want to evaluate its performance over a longer period. So multiple things are there. Risk adjusted return. What is risk adjusted return? Is comparing the return of a mutual fund with the risk which is being taken. How do you do that? You do it through these Sharpe ratio, Traynor ratio. Sharpe ratio is basically measuring the excess return to the standard deviation. Traynor is measuring the excess return to the beta. Sortino ratio is also there, which is not very critical because there's no problem solving which is there. And expense ratio is also one of the measures. This is not to measure risk adjusted return. What is expense ratios? Average expenses being incurred. If you have a very high expense ratio, you may want to come out of the mutual fund. Benchmark return. Every mutual fund will ideally have a benchmark for it. Let's see this. Just give me a minute. There should be a benchmark for every mutual fund. Most of this, I hope I get the information, but there will be a benchmark for everything. There can be a large cap benchmark or a mid cap benchmark. So this is the benchmark versus Nifty 50 TRI versus Nifty 50 TRI. So comparing it with the benchmark index, comparing it with the peers category, search within the category. So you can either do a comparison with the peers, you can compare it with the benchmark, and also see how is the fund performing across different return and risk cycles. That is, a market goes through a lot of economic cycle. It goes through a up movement, it goes through down movement. So how are we performing during those times? Then qualitative parameter, these are subjective. Qualitative parameter majorly will focus on two things. One is how is the fund manager, how strong is the research team. So track record and competence of the fund manager, credibility of the fund house team. Quality of portfolio is checking how the quality is there of different equity. So equity quality can be seen whether you are investing in blue chip companies. Debt part quality can be measured through your duration, volatility, credit quality. Objective is to invest in those companies which are having good quality. How is the fund manager performing, and how is the credibility of this fund house team? One is on the research side, second also on support which needs to be given. An MF investor may need some support. He may need some support on redemption of units, crediting of dividend, or he wants some information. Is the mutual fund giving those information or not? So you will have to take care of investment side as well as the administrative task. What is the role of a fund manager? I think the most important role is being played by a fund manager. For a mutual fund, the most important role is being played by a fund manager, and his role depends on the category of mutual fund. Active, passive. There are two types of mutual fund. So the role will depend on whether it's an actively managed fund or a passively managed fund. If it's an actively managed fund, understand clearly, I want him to generate alpha. Alpha means outperformance. Passively managed fund, I want the fund manager to have low tracking error, minimum tracking error. This is primary objective. For an active managed fund, I want him to generate positive alpha. or outperform. For a passive managed fund, I want him to have minimum tracking error. Apart from this, he has to take care of the other things, which is whatever compliances are there from SEBI side or from AMFI side. He has to do constant monitoring of the performance of the fund, whether to check whether the fund is doing well, not doing well, creation of wealth and protection of wealth. If you are outsourcing your work to someone else, he is responsible for the work done by all the third party. Write about role of foreign institutional investors in mutual fund. FIIs are basically the institutional investors who can give large money, who can give substantial investable funds. They are registered abroad and they invest in Indian market. They can invest in equity market, hedge funds. Hedge funds are basically those risky funds, pension funds, mutual funds. Because FII came in, there is good benefit also for India. What is the good benefit is whenever FIIs are making investments, one, in the India, whichever companies are there, they enhance their corporate governance. Also, money comes in, because of which I'm able to do expansion. Expansion is giving me employment. It can also improve, it can provide employment. And these FIIs can invest in domestic mutual fund directly through the insurers, which is direct plan, or you do it through registered stock brokers. You do it through the stock brokers or you do direct investment. So mutual fund, I'll just summarize what we did. A mutual fund is basically a trust. It is basically a trust which is pooling the money together. It is a trust which is pooling the money from like-minded investors and investing in as per the scheme objective. There can be an open-ended scheme where entry and exit is allowed at any time. Close-ended, entry at IPO or new fund offer, exit on maturity. Interval, entry and exit at specified interval. Growth fund is focusing on increasing the long-term capital appreciation. Aggressive funds invest in high-risky companies. Income funds is investing in companies which give stable dividend and stable interest income. Bond funds is going to invest in multiple bonds. Gilt fund is investing in government security. Then you have special kind of funds. Index funds is going to invest in index like Nifty index or a mid cap index. International fund is basically which is located in India, raises money here but invest globally. Offshore is opposite. They raise money outside and invest in India. Sector fund will invest in only one specific sector, real estate or automobile, any specific sector. Money market is going to invest in short-term instruments. Fund of funds is investing in other funds which are there. Capital or protection oriented fund is focusing on protecting the capital by investing bulk of the money, 80-90% in safe securities. Balance, they will invest in some risky ones. Gold funds will invest in gold. Quant fund is to remove the human biasness, where the selection of the fund will happen based on certain data driven approach. Ownership classification, there's a public sector mutual fund, there's a private sector mutual fund and foreign mutual fund. Direct plan are those where you do investment without an intermediary, so there is going to be lower expense ratio. Different schemes. Balance fund is investing in both debt and equity. Equity diversified funds are those which have diversification benefit. ELS is for ATC. Sector funds is investing in a specific sector. Thematic is going by specific theme. Example, Make in India. Hedge funds are aggressive, high risk kind of a funds which are not having major regulations. They try to get very strong returns, but they carry strong risk, high risk also. Cash fund is like a money market fund. ETF are those funds which are listed in the stock markets where an entry and exit can happen during the day by doing buying and selling in the market. Fixed maturity plan are basically like a debt instrument which has a fixed maturity, 3-year maturity or a 2-year maturity, and it tries to give you the fixed amount on the maturity. How can it give fixed amount on the maturity? By investing in safer asset classes. Advantages, professional management will be there, diversification is there, it can give you high return, low cost of management, liquidity side benefits are there. Disadvantages, there is no guarantee of performance. Selection of a fund can also be an issue, and diversification gives you lower risk but also leads to lower return. Trail commission is a commission paid by the MF investor to the distributor who is advising him. Expense ratio is the amount incurred by the mutual fund on various expenses which it needs to incur. There will be a cap on the expense ratio. Side pocketing will work in case a debt mutual fund has invested in multiple security and one of them has become illiquid. Why did it become illiquid? Because there is some default which has happened there. So you move this to a side pocket and the main fund continues to be there. You can continue to be a buyer and seller in the main fund so that continues to be liquid. This illiquid fund, if the money is collected back, it will be given back to those investors. How do you measure the divergence or deviation of performance? This is through tracking error. How can you evaluate the performance? Whether the mutual fund is generating adequate risk adjusted return through Sharpe ratio, Treynor ratio, Sortino ratio, or go through expense ratio, whether you are able to meet the benchmark or the peers, and how is the performance across different economic cycle. The qualitative parameters, what is the quality of the portfolio, what is the credibility of the fund house team, how has been the track record of the fund manager. Role of a mutual fund manager depends on whether it's an actively managed fund or a passively managed fund. Actively managed fund focuses on alpha. Passively managed fund focuses on reducing the tracking error. Apart from that, he has to take care of compliances, constant monitoring needs to be done. He has to be under control. He is responsible for work which is outsourced to third party, and creation of wealth and protection. FIIs are basically large foreign groups with substantial investable funds. They can directly invest in the domestic mutual fund from the issuers or go through a registered stockbroker. Because of the FIIs coming in, there is an improvement in corporate governance. New sources of capital is there. Because of the new sources of capital, companies expand and create employment opportunities. With this chapter is over. If there are doubts, you can just message me.